Please confirm if you can see my screen. Yeah, that's okay, I think. So at this example, I was just mentioning that the Bollinger Bands is giving you an indication of the volatility of this market. So for example, if you want to go in this place, so you want to like go long to buy from this, you can put your stop here below this levels, because this is where the market should not cross. If the market crosses this way, then it can change the direction. So you can here put your stop at this levels. So let's see this table. We, if we have a $5,000 account and we decide that we only risk 1% of this account in each trade we will go. So if in 9 trades, if we have failed in 9 trades, this means we did like buy, sell, we had our stop loss, and then the market go against us. We did not make profit, we only make loss, we hit the stop loss. If we did this for 9 times, this is a lot. 9 times is a very, very big number for a trader to take losses. So if you apply this principle of only risking 1%, after 9 trading losing trades, you will only lose 9% of your account. You will still have equity of 9%, or around $4,500 from your $5,000 account. So if this number increased to 5%, if you decide to risk 5% of your account in each trade for the same number, 9 trades, and you lose, if you lose this 9 trades, after 9 trades you will have 63% left in your account, which equal to around $3,150 from your initial $5,000. So between these tables we didn't change anything. You lost in both trades, you lost 9 times. The only thing we changed is the risk percentage, and the difference is huge. If you can see, if you recall, at the first risk table, after 9 trades, you end up still having 91% of your account. You almost lost nothing, just 9% of your account after 9 losing trades. And in the table number 2, if you risk 5% in each trade and you lose 9 times, then you will only have 63% of your account after 9 losing trades. So what's the difference? The difference was only because of your risk percentage. So if when you start a trade, if you are sure that you will win this trade, you know, you did your homework, you did your analysis, you know that gold is going up or the euro is going down, you know where the market is going. You think you know where the market is going. As we mentioned in our last webinar, that no one knows for sure 100% where the market is going. So you only predict, and you have 50% chance, at least 50% chance that the market will go against you. So when you start your trading, have this table in front of you. Imagine it, that only by increasing risk per trade, only by increasing this percentage, you are increasing what will happen in your account if you lose. So like 1, 2, 3, 4, 5, 6, 7, 8, 9, this 9 trades will happen. If it happened with a 1% risk trader, he will only lose 9%. If it happened with a 5% risk trader, he will end up losing 60. He will end up having only 63% of his account. So if you are actually risking more than that, you can end up losing all your account in one single trade. And this happened a lot with a lot of traders. Let's see the other way around. What happened if we profit from this sequence, like 9 trades? We only risk, let's say, 5% of this $5,000 account, and we combined our risk. So in each trade, we will make a 2-to-1 risk to reward ratio, as I explained this in our last webinar. So if your stop loss, for example, is 20 points, 20 pips, your take profit should be 40 pips. If in gold, your stop loss is $10 per ounce, your take profit should be $20 per ounce. So if you apply this principle and you can actually win this 9 trades, you will end up doubling your account. See the number, if you start with the $5,000 account and you apply this 2-to-1 principle and you only risk 5%, and you sure you know what you are doing and you can win this 9 trades, instead of trying to double your account in only 1 trade, you can do this in 9 trades. And if for any reason you lose during this way, you will only end up losing 5% of the account. This will be a very safe plan. So you will start with the $5,000 account. You will only risk $250. And after the first trade, you will add this to your account, $500 profit, and this add up will go until you will almost double your account in the last trade. Is there any questions? So the bottom line, before I take a question, is the money management in Forex is it's very flexible. You can apply any one of the stop loss kinds we just mentioned. You can combine them all, as I will give you a practical example, a live example right now. But you have, at least you have to have a money management plan. You have to have money management in your trading plan. You have to practice some form of it in order to succeed in your trading. So if someone have a question, if anybody have a question, I'm ready to take it now. Please write it in the chat box and I will answer it. And in the meantime, I will, until you get your question, I will give you some live examples. So please confirm if you can see my my screen. I'm now opening the chart of dollar yen in the MT4. So please confirm if you can see my screen. Okay, and I will now give you an live example. Okay, let's go with the euro dollar. I think this is everybody likes it. Everybody use it. So here we have the euro dollar. This is the 1 minute chart. We are using this just to make a quick example. So the moving of these candles is faster. For example, if we want to, let's say that our indicators, our analysis is telling us to buy the euro dollar, so we will buy. Okay, this account have almost $4,000. So if we apply this principle, let's say that we will risk 5% of this account. So the 5% is actually around to $100. So let's say we will go with the $20, $200 stop loss. So 20 pips. Let's buy here and have our stop loss like this will be around 20 pips. And let's have our take profit also. So this is almost one-to-one. It's because I'm just trying to give you a quick example. It should be like 2-to-1, but because at least keep it 1-to-1. At least keep it 1-to-1. Don't ever do this. Don't, like, if you increase your stop loss, it become like more than 1-to-1. So meaning if you lose, you lose 2. If you win, you win 1. In this way, this is wrong. Don't do it this way. Okay, always keep it at least 1-to-1, meaning if you are going to lose 1, you are going to win 1. You expect to win 1. So this is the way. Actually, in this stop loss, we applied all the principle we were talking about. We started by applying the equity stop. So we mentioned that 5% will be our stop. Okay, and when we looked, actually I did this very fast, I didn't explain it to you. When I looked, I found here a support level. Can you see this? Let me draw a line. There is a support level. Okay, so I felt that my analysis telling me that under this point, this will be a support point, so my stop loss should be just under this point. So this is also the second thing. The third stop type we speak about, which is the volatility stop. You can see the Bollinger Band here is actually in the same place. You see here, it's in the same place with the line. So actually my stop loss could be here. If my stop loss is here, I can increase my volume, I can increase my lot size. Because actually right now my stop is only 10 bips, so I can go with another one with the same stop loss. This will be my second stop loss. Okay, and the take profit will be the same as my other take profits. Okay, let's say like this. We can move stop loss after we write it. We can move it like this with the cursor. So as you see in this example, we combined the 3 types of stop loss. We combined the equity stop loss with the our analysis, the indicators, and also with the volatility. So at the end of this, we measured where we can have our stop loss and where we can have our take profit. So does it mean that I'm 100% sure I will win this trade? No, but at least even if I lose, even if I lost this trade, I will only have lose the 5% I already accepted to lose. Okay, I'm giving the market only 5% of my account. This 5% could be one lot with a stop loss here at this level, or two lots, two standard lots at this level. Okay, it's the same percentage. This is what I'm trying to say. It's the same 5%. It was, if it's one lot, it was here 20, around 20 pips. If it's, I change my stop loss to only 10 pips, which is, it's very close stop loss, but just like a scalping trade. So if it's like this, the same risk, the 5% risk, it will give me the ability to add another lot to my lot size, to my trading size. So what I'm trying to say at this example is, if you want to risk certain amount in your account and you want to trade big, you can use this close stop loss. You can use it, okay? If you cannot use this, your indications, your analysis is not here. It's not giving you this. I repeat that we felt that this is the right place to put our stop loss because of the Bollinger Band, because of the this support level. We think that this is the right way. We don't have any greed. We think this is the right way. Okay, sometimes you think it's the right way, but the market go against you. It's fine. But at the end of this trade, I will only lose 5%. Whether it's only one lot here at this level, let me have a line here, one lot here, or as we did two lots here. So adapt to the stop loss, use all what we speak about today, try to combine it together. Actually, this is the best way to combine all the indications, all the stop losses kinds we spoke about. You make a certain percentage, for example, 2%, 3%, up to 5%. I don't recommend more than 5%. Actually, 5% is a lot. But let's say you accept this risk. So 5% is fine. And actually, don't put in your account, in your trading account, all your money. Only have amount you can afford to lose. Okay. So 5% of this account in the trade. And then you can, after this percentage, have your analysis. Before I go to the trade, I know that I will only risk 5%. Okay, I'm going long, I'm buying, or going short or selling. I'm trying to find the right place. The analysis, the technical analysis or fundamental analysis is giving me. So for example, this is the place. Okay, I'm combining both my percentage and my technical analysis, and I also using Bollinger Bands to see the volatility. And a quick note, maybe you can use this. If you see this Bollinger Bands, when it's coming like this, very, very close to each other, this indicates to you, that tell you that the market now is moving slow moves. And when it's wide like this and like this, it's giving you an indication that the market is going in a very big moves. This is clear, correct? But what I'm trying to tell you is, whenever you are here in this very close, very tight lines, you expect that the coming move will be big, and the opposite. This is, if you can see my cursor, this candle happened when we have the core CPI news today. So it was a very, very strong move. After this wide, strong move in the Bollinger Bands, if you have this wide Bollinger Bands, it gives you an indication that the coming move will be tighter. It will not continue like this for a long time. And actually, this is what happened after this. It became very, very tight. I'm reminding you that this is a 1 minute chart. I'm just using this as a quick example for you. You can apply the same principle even if this is a 1 day chart. If it's one chart, it's the same principle. You can apply the same principles in any candlestick chart. Okay, so this was actually our trade is getting some profit. Maybe we will just leave it for some time, and it might hit the take profit, but maybe not now. Maybe it will take some time because there is no big news right now, but we think at least if we have this trade go to be a losing trade, it will only take 5% of our account. If it's a winning trade, it will give us around 5% of profit. So this was the live example. I wish that everything is clear and you can now apply these principles in your trading. Money management and risk management was our last topic, risk management, and today's topic is money management. These both are your arms in the battle. You need to always keep monitoring your risk management and your money management. This is the most important thing in Forex trading, okay? I don't care what's your analysis. I don't care, are you going long or short, as we mentioned in the first slide in our webinar today, that some traders, two traders can go in the opposite direction. Some is buying, someone else is selling, but because they are not applying the money management techniques, they both end up losing, okay? And the opposite, maybe two experienced trader is going in a opposite direction. Someone is buying, someone is selling, but they end up making money only because of the money management techniques. So if you have any question, I will be more than happy to answer. And I will just keep this trade until it hit take profit or a stop loss. So please join our upcoming webinars. We have online free webinar each and every Thursday at 6 p.m. Dubai time. If you have any question, I believe that you have my contacts sent to you by email. You will have a recording of this lecture